Millions of people in the UK who receive universal credit could see their payments reduced or withdrawn entirely, depending on how much they earn from work. The Department for Work and Pensions has set earnings limits that, when exceeded, will immediately change how much benefit you're awarded. And many people are unaware of them. Claimants are not limited by the number of hours they work, but by their total income. If either they or their partner earn above a certain amount, it can result in a lower UC award or even losing it altogether. The DWP has confirmed that other sources of income, including savings and self-employment, are also assessed. So if you're on universal credit, it's important to understand how these limits and deductions are calculated to make sure you're not affected, or know someone who isn't affected. Today, we'll be looking at the latest news around universal credit and how much you can earn without affecting your benefits. We'll also look at the latest income threshold and deduction rates and how they may affect you. Let's get right into today's video. If you're new to this channel, I'm from The Money Edit, and this is the place where you're going to learn how to make smarter financial decisions. I'd love it if you hit that subscribe button so you don't miss out on any of our awesome weekly content. Now let's get into it. So first, let's talk about how the taper rate system works and how it affects the amount of universal credit that you receive. Basically, once you start earning above the work allowance limit, universal credit uses a taper rate to gradually reduce the amount you receive as your earnings increase. For each £1 you earn above the work allowance, you'll lose 55 pence from your universal credit payment. So for example, if your work allowance is $411 per month and you earn $500, you'll lose 55p from your UC payment for each of the extra $9 you earn. That would mean you lose $5. For more detail on this, check out our previous videos on the topic where we go into more detail on how this works. There are two different work allowances that the DWP applies. People who are receiving housing support or living in temporary accommodation have a lower work allowance of $411 per month. Everyone else who isn't receiving help with housing has a higher work allowance and can earn up to $684 per month before deductions apply. These figures are fixed and only apply to income from employment. Self-employed universal credit claimants are responsible for reporting their monthly income themselves, whereas those in traditional employment typically have their wages reported directly to the DWP by their employer via the real-time information system used by HMRC. Remember that these are just the limits for earned income. If you've got other sources of income such as benefits, pensions, or investments, you might need to report them to the DWP as well. The next thing we need to cover is how the DWP deals with other income sources and how savings can affect your universal credit award. As you may already know, if you're receiving universal credit, you must declare all sources of income, and the DWP takes these into account when assessing your eligibility for universal credit and determining your payment level. According to the latest information published by the DWP, if you're on universal credit and you have savings of over $6,000, your universal credit will be reduced by $435 for every $250 that you have above this amount. This means that if your savings are between $6,000 and $16,000, your universal credit payment will be reduced by a maximum of $517. If your savings are over $16,000, you won't be entitled to any universal credit. This is because you will be considered to have sufficient savings to support yourself and won't need the help that universal credit provides. It's important to note that the DWP counts the savings and investments of both partners when assessing a household's total savings. This includes any savings held in joint accounts as well as individual accounts. So even if one partner has more than $16,000 in savings, it could affect the universal credit payment for the whole household. The same rule applies if you're applying for universal credit and your partner has savings. The DWP assesses the savings of both partners jointly, meaning that a partner's savings are taken into account regardless of whether they're applying for universal credit or not. So to recap, here's what happens to your universal credit if you have savings. If you have less than $6,000 in savings, your universal credit payment won't be affected. Now let's take a closer look at how other types of income are treated when it comes to universal credit. Income from rental properties is included in your total income and will be taken into account when assessing your universal credit entitlement. This applies to both furnished and unfurnished properties. If you receive rent from a tenant, this is considered income and must be declared. Any income from part of your property being used for business purposes, like letting out a room to a lodger, is also taxable and must be included in your self-assessment tax return. If you receive child or spousal maintenance from a former partner, this is considered taxable income and must be declared to the DWP. However, if you pay maintenance to a former partner, this is not deductible from your income. Any pension income you receive, such as a state pension or private pension, is included in your total income and will impact your universal credit payment. Again, any income from dividends or shares is also subject to tax and must be included in your self-assessment tax return. If you're receiving universal credit and want to earn more money, it's worth considering starting a side hustle. Not only could it potentially increase your income, but it could also provide you with valuable skills and experience that could lead to a full-time job. If you do decide to start a side hustle, it's important to remember that any income you earn will be subject to the same rules as any other income and must be declared to the DWP. This is because any income you make from your side hustle will likely push you further into the taper and could reduce your UC payment. But as long as you're transparent about your earnings with the DWP, you should be able to continue receiving universal credit whilst working towards making your side hustle into your full-time career. In conclusion, it's important to remember that these rules apply to all universal credit claimants, regardless of how they earn their income. Whether you're employed, self-employed, or receiving other sources of income, you must declare all of your earnings, and the DWP will use this information to assess your eligibility for universal credit and calculate your payment. If you've got savings, it's important to be aware of the limits set by the DWP and make sure that you don't exceed them. Otherwise, you could be subject to penalties or even lose your universal credit entirely. And there you have it. Thanks for watching this video. If you found it helpful, please drop us a like and don't forget to hit that subscribe button. Hope to catch you in the next video.